So what is future contract? Let's understand today. So future are again a kind of a derivative contract, a contract which derives its value from price of an underlying asset. You can find various kinds of future contract. Okay, it can be into commodities, stocks, currencies, bond, or maybe any index. So yesterday we studied about forward contracts. Today we'll study about future contract and we'll understand main features of future contract and the valuations and how we can use the future contract in hedging risk. Okay. See, hedge using future contract is pretty simple and a little less complicated as compared to options, because options are highly dynamic in nature. The pricing is highly dynamic. So let's first understand futures, and then we'll go further ahead with the option contracts. So a future contract is a standardized form of contract, or we can see it is a standardized contract between two entities where settlement takes place on a specific date in the future. And this contract is in between two entities where settlement takes place on a specific date in future at today's pre-agreed price. However, these are exchange traded. Okay. So first one is, what is a standardization? I'll give you an example. Let's say if you go to McDonald's, you go to any branch, any franchise, you have the same taste of the burger. If you're taking any chicken grill sandwich or chicken grill burger or anything, whatever you order, it tastes same at every franchise. Whereas if you go to a local restaurant and the restaurant have, let's say, 3-4 branches across the city, it's quite possible that the dish or the curry you have ordered there, quite possible that it will taste different. So you would prefer going to one particular branch rather than going to any branch because the taste differs. So standardization is a process where we set the terms and conditions for each and every contract in the same way, or the terms and conditions for each contract is same. Every contract is same. Now again, same as the forward contract, the settlement takes place in the future. Same with the future contract also. And one different here is that with the forward contract is that these future contracts are exchange traded, whereas the forward contracts were over the counter traded. So it is exchange traded. The future contracts are exchange traded and forward contracts are traded on over the counter. Now what are the standard terms in the contract? See, these are all the standard terms in any contract. Okay, in forward contracts also, in future contracts also. However, I'll tell you how it becomes a standard when we are trading on recognize the stock or commodity exchange. See, the exchange decides that which stock will be traded over the exchange or which commodity will be traded over the exchange. So this is decided by the exchange. Let's say there are thousands of commodities in the market, but the exchange will select those 100 or 200 or 300 commodities which they want to allow trading over the exchange. See, we have, let's say, over 5,000 companies listed on Bombay Stock Exchange in India, and out of that hardly 200-300 stocks futures are traded over the exchange. So that completely depends on the exchange which they allow. So they set the product and asset. Then price is again in our hand, that is basically demand and supply. Quantity is set again in terms of lot sizes. So what is a lot size? Let's say they will set that you can buy minimum 1 ounce of gold. You cannot buy 1 gram of gold. They'll set a lot size like you have to buy at least 1000 kgs of copper. Okay, you cannot buy, let's say, 1 kg of copper online. So the minimum lot size is 1000 kg. So whatever is the minimum lot size, you can say you can buy that lot. Okay, if you want to buy 500, you cannot buy. If you want to buy 2000, you can buy, but buying 2 lots of the same contract. Or you can say you can buy 2 contracts or 2 lots. Okay, so let's say if they say that the minimum, let's say silver contract will be for 5 kg. So you cannot buy 1 kg silver. You have to buy 2 lots of the silver contract. So what happens is if you are looking for to buy a lesser kg one, so you have to look out for another contract which may have a lot size of 1 kg. So for 1 kg they might have a different contract. For 10 kgs they might have a different contract. Okay, it's not necessary that if let's say that you'll get a lower lot size contract also. It's not necessary. But if you are willing to, let's say, trade in micro lots or mini lots, we call them micro or mini lots, or smaller lots. So if you want to trade in micro or mini lots, you have to just check out on the exchange, are these contracts available? If it's available, then you can trade. So again, the contract is standardized, the quantity is standardized in forms of lot size. So if you want to buy 100 kgs, you have to buy 1 lot. That will give you 100 kg, and another will be selling at the same time that 1 lot of 100 kg. Quality standards are again set by the exchange. So here quantity is set by the exchange. This will be the minimum lot size. Delivery is set by the quality standard is set by the exchange. Let's say gold will be for 22 karat or 24 karat, and what will be the moisture in any grain or whatever it is. So that is set by the exchange. Now delivery date, what should be the delivery date? Now in case of stocks, the delivery date is a little different than in case of commodity, the delivery date is a little different. Normally, if we talk about stock exchange, delivery and expiry are same in case of stock exchanges normally. Okay, that means the last trading day you can mark the delivery. Okay, that depends, it's an American option or European option in case of option contract, but normally in future contract you can mark the delivery at the time of expiry. And in commodities, normally you have to mark the delivery in advance. Let's say the contract, to understand the delivery date first, I will better say that you understand first the expiry date. What is expiry date? Basically, exchange has different month contracts. Yesterday we saw that the crude oil has almost every month contract over MCX. So we can find the crude oil contract on the MCX for every month. So let's say next 1.5 years almost. So what happens is that normally on stock exchanges in India, we have 1 month contract, 2 month contract, and 3 month contract. And in commodity exchange, we have, let's say, 1 month to, let's say, 6 months, or maybe 1 year. That is not fixed here. And the 1 month contract is also referred as a near month contract or the current month contract. Second month contract is referred as next month contract, and third month contract is referred as a far month contract. So how this functions? Let's say on 1st January, one contract was launched by the exchange and people can buy or sell the contracts. Okay, see, I tell you one thing. Unlikely shares, like shares are being issued by the companies, IPOs are being launched, and the number of shares are fixed. In case of contracts, there is no fixed numbers. I'll explain you that. That is called open interest. We'll understand that concept. So for now, you understand that the exchange only sets the terms and conditions and allow you to start trading into those contracts. It's not like that they issue the contract and you buy. Okay. So how a contract is basically formed, you have to understand this. But it's very simple, that if there is a one buyer and there's one seller, both goes into a contract. Okay, let's say buy says, I'm gonna buy gold in future on 31st of January, you have to give me delivery. And the other person says, okay, I'm ready to sell the gold future and I'm gonna give you the delivery on 31st of January. So they go into one contract. So one future contract is formed. Okay, so one future contract is formed. So likewise, there are many buyers and sellers. They form plenty of future contracts. Okay, so trading is only allowed by the exchange. So let's say on 1st January, exchange allows trading in 1 month contract, which will expire on, let's say, 31st January. Okay, so in commodity, they give you the starting date and the end date of the contract. On 31st January, this is going to expire. And the same on 1st January, they also start a 2 month contract, which is going to expire on, let's say, 28th of February. And they again start one more contract on 1st January, that is a 3 months contract. Okay, so let's say that's going to expire on 31st March. So what happens is on 31st January, this contract is closed or expired. Okay, you cannot trade into this contract. But this second month contract has 1 month validity left. So this second month contract becomes 1 month contract. And then this 3 months contract becomes 2 month contract on 31st January. And a new contract is being launched on, let's say, 1st of Feb by the exchange for 3 months validity. So same contract remains in the market and one by one they expire. So what happens is when we are trading in contracts, I tell you one great thing about trading in contract is, let's say you buy on 1st January in the morning. If you want to sell it today only, you can sell it. If you want to sell it on, let's say, 10th January, you can sell it. If you want to sell it on 25th January, you can sell it. If you want to sell it on 31st January, you can sell it. So anytime you can buy or sell the contract. But you have to close your position. That means you have to sell and close your position if you have bought. Or if you have short, you have given a short sell, you have taken a short sell, then you have to square off position by buying the contract. So in any case, on 31st of January, you have to close your position. Okay, if you do not close your position, exchange will automatically close your position. So one great thing about this contract is that you can keep it for, let's say, 2, 3, 4 months, anything you want. Then again, another good thing is you can take both positions, that is a long position and as well as short position. So long means you buy first and sell later on, and short position means you sell first and buy later on. So both the positions you can take in future contract on the exchange. Okay. Also, future contracts give you great leverage. Normally, when we are trading in future contracts, okay, I have to discuss first the delivery date, and then I'm going to discuss about the advance margin. So we understand the expiry date. That means on 31st of January, contract will expire, and you are not longer allowed to trade into that contract. So that is expiry. Now, in case of stocks, normally the expiry is same as the the delivery date is same as the expiry date. But in case of commodities, in most of the exchange, you have to mark the delivery in advance. Now that is specified by the exchange in contract specifications. Okay. So that is actually given in your contract specification when to mark the delivery. Okay. And then exchange will arrange for the commodity you actually want to get delivered, and will store in the warehouse, or will just make sure that the commodity is with them. They need some time for that to arrange a delivery, and they normally take delivery margin also from you, and after the expiry they give you 4 or 5 days as a grace period to collect the delivery from the exchange warehouse, and they give you a warehouse receipt, okay, which you can produce in front of them and collect the delivery, and you have to make the full and final payment. Okay, and that has to be before the taking the delivery. Now, there are two kind of margins in the futures contract trading. One is called initial margin. That is at the time of getting into the contract. And another is, let's say, delivery margin. We have far more other margins, you'll understand. So initial margin is basically, if you want to buy a contract, you have to pay this much. And delivery margin is like, if you want to get the delivery of the entire lot, then you have to pay this much of money. So this is advance margin and delivery. Okay, expiry date we understand. Now there are penalty terms also. Penalty is normally set for those guys who have marked the delivery but they have not collected the packet, or somebody who said that I'll deliver to the exchange. Let's say I have short sold gold, let's say 1 ounce of gold, and on the date of expiry or before that I say, let's say I mark to the exchange that I will not square off my position as net. I'll do a gross settlement and I'll deliver the gold to the warehouse of exchange. So in that situation the seller will deliver. So either buyer does not come to buy on time or the seller does not deliver on time. In both the cases they have to give penalty. Also, one more thing interesting is that exchange has to give penalty to the buyer in case if they fail to deliver it on time. So exchange is also accountable. Okay, let's say you mark delivery for, let's say, 1,000 quintals of maize, and the exchange fails to deliver that. In case, the exchange has to pay the penalty. You know, I know one guy is having a good company with a lot of funds, and he had some sources in the exchange. So normally exchange gives you inventory data at the end of every day, I suppose, or weekly for some commodities. So what they used to do is, obviously the inventory data they have openly, but they have some internal information also from the working staffs, and they just try to figure out that how much stock exchange has, and they used to mark the delivery, okay, above and excess of the stock maintained by the exchange. And they're very smart. They knew that the exchange is not having that much of stock in hand, and exchange will surely fail to deliver the goods. These guys were not having great capital, but they used to actually mark huge amount of delivery, great lots. And for obvious, the exchange will fail to deliver the lots, and the exchange has to pay the penalty. And they used to make money from this penalty only. So I don't know, there are different kind of people, different kind of mind they apply. Now this is very smart, okay. I won't tell you to try this thing unless you're having good amount of money and some resources in the commodity exchanges or the warehousing, because normally you will get to know that which warehouse will deliver what. So you have to set a person there. But again, as I told you, don't do this. Do normal trading. Then we have contract transfer term. Then we have contract transfer terms, and this signifies basically, this actually allows you to trade in the future contract, which makes it tradable. You can sell your contract to anybody, and anybody will pay you for that. So how you trade on the exchange? Very simple. You open a trading account, as I showed you yesterday, and I saw you yesterday, and it was very easy, pretty easy. And you need to have internet connection, and you're connected with so many traders through an exchange, and you can trade. So as I told you, the future contracts allows both the positions and the long position as well as the short sell position. Okay. Now the future contract does not involve any kind of default risk. What is default risk? The buyer or the seller can deny to deliver the good. Okay, so both of them can deny to deliver the good. So let the price rises high, the seller will say I will not sell, or the price goes too low down, so the buyer will say I will not buy. So in both the cases, they are default risk. So payment may not be paid, or let's say dues may not be cleared. So there's a default risk there. In case, so hold on for a second. It's giving me some back again. So how do we avoid the default risk? Now, normally to avoid the default risk, we have a third-party guarantor. Okay. So I give you a layman example how they avoid the default risk. Very easy. Even simple example. We have it's in India. Cricket is very popular. So people like to play a lot of cricket, and they love to watch matches. So let's say there is a match between India and England, and let's say Paul comes to me, and let's say he says that, hey, will you bet on the India and England match? So I say fine, no issues, I'll bet. So Say, okay, fine. So if England wins, I'll pay Paul, and if India wins, Paul will pay me. Let's say the bet was for around $100. Very simple. So what happens is, let's suppose India wins, and Paul denies to give me. Say, boss, I'll give you tomorrow. And I call him again and ask him that, Paul, you were supposed to give me $100, which actually you lost the bet and you have to give me the $100. So the Paul says, don't worry, friend, I'll bring it back to you tomorrow. Give me one more day. The next day again you call and he says, give me 1 week time, I'm going through a financial crisis. And they say, after a week, they say, give me Paul. Say, come on, you're my friend. Just for $100 you are poking me every time so much troubling. Come on, it's nothing. It's just a penny. Come on. Just, I'll give you. I'm not going anywhere else. So, okay, fine. So you again budge him after a month. And then this time Paul is really angry. You, come on. Yeah, the friendship is more important than your $100. Actually, Paul made a default. Paul is in no mood to give me $100. So what happens is, there is a default risk. But again, let's say this, again a match there between India and Pakistan, let's say England. And this time, the Paul comes to me again. He thinks that I'm pretty smart and the sir is little, the teacher is, the faculty is little, stupid. Or you can say kind of, not stupid, but has little, simple. So I can make him fool again. Hold on for a second, somebody is knocking my door. I'll come back. What is initial margin actually is? This is the amount of cash that must be deposited in the account to start trading contracts. And it acts as a down payment for the delivery of the contract and ensures the parties honor their obligations. So to avoid default risk, both the buyers and sellers pay the initial margin amount. Okay, so let's take an example. What is initial? Let's understand the initial margin concept. So let's say I want to buy one mini lot of silver contract on MCX. Okay, so one mini lot involves 5 kgs of silver, and this 5 kgs of silver, the price for 1 kg is, let's suppose, 50,000. Okay, so 5 kg, for 5 kgs it will be around this much. Okay, so that is around 250,000 for the 5 kgs silver. Now, so you don't have to pay the entire amount, the total amount, to buy one lot of silver contract. You simply have to pay the initial margin given by the, or stated by the exchange, mentioned by the exchange. So let the exchange mentions, let's say, or ask you to pay, let's say, 10% as initial margin. So that means you have to pay around 25,000. If exchange says pay 5%, then you might have to pay just 12,500. Or if exchange say pay just 1%, then in that situation you have to hardly pay 2,500. But normally the initial margin very much depends on the volatility of the contract. Okay, the pricing into the underlying asset. See, underlying asset is, let's say, highly volatile. Let's say it's volatile of, it's, let's say, 4% volatility is daily. Let's say consider there's a volatility of 4% daily. Then in that situation, they'll definitely gonna ask you almost 15% as initial margin. If the price volatility is hardly 1%, then they ask you to pay, let's say, 3 or 5%. So this depends on the daily volatility. There are various models used to calculate the volatility and the initial margin. We call it daily span. Okay. Now let's take an example. Okay, and I'll show you how the initial margin is being calculated. And normally there are two methods. One is like your broker or the exchange will provide you a list on their website, which will give you the margin requirement of all the contracts. Another option is that your broker may give you access to initial margin calculation, let's say tool, any kind of tool which will help you to figure out how much margin you have to give for the particular contract. So both the ways there, either download the list, check how much initial margin is required, or you can simply apply any tool and calculate the margin. So let's take an example. How do we calculate the initial margin to buy a contract? So for that I have to log in into my account. So to get the initial margin required, how much initial margin is required to trade this contract, to buy this contract, first I have to add this script. Okay, the script I want to trade. So let's say I have selected copper for the current month, and I'll also select copper for the next month. So these are two scripts I want to trade. Both have almost the same prices. Now, so how much margin I require? For that you have to look for a span calculator in your software. You will definitely have a span calculator or the margin calculator. And again you have to now add the script here. Let's say I want to add the copper contract, add to grid, and now calculate the margin for one lot. Now the margin for one lot is around 18,248 rupee. So almost 18,000 you have to pay to buy one copper contract. Now what is the lot size actually? Just want to check the lot size. See, copper is one lot size is, let's say, 1 metric ton. So that means the series is here is empty. So the one lot size is for around 1000 kgs or 1 metric ton, and for that we have to pay around 18,000. So let's see how much percentage we have to actually pay to buy one lot. So the price is, let's say, 350, the lot is 1000. So this goes to, into this comes to 3,15,000, and how much we have to pay? 18,000. So divided by 3,50,000, so almost 350,000. So it comes to around, in terms of percentage, around 5% we have to pay to buy one lot of copper contract. Okay, so it's pretty simple. Either you know the percentage, then you multiply it with the lot size and calculate, or else it is you can calculate through the the span calculator. Now I'd like to show you one more thing, that is the contract terms. Okay, what are the contract specifications, normal contract specification into a future contract? So for that I have to visit the website of commodity exchange. You have to do it for your exchange. Let's say we go to MCX India.com. It's the website of commodity exchange. Also we'll see LME. So we have London Metal Exchange. I'm opening both. So here, to find out the contract specification, I go on products, and then I want to just see the copper contract. I click on copper, and then on the right hand side I have contract specification, and then we have two contracts here, June 2014 contract and February 15 onwards. So currently we are following these terms and conditions. So I click on the contract, let it load. Let's go to London Metal Exchange. Okay, and we have home trading, contract type future, options. We have options, commodity options also being traded over London Metal Exchange, and then the futures we have metals. You have so many metals being traded. Okay, so let's take out copper again here. So we have the LME copper price, okay, for the exchange, and also I'll check the contract specification of the future contract. So we have the contract specification for the future contract of copper. The minimum lot size is 25 tons. Prompt dates daily, weekly and monthly. Then we have quotations in US dollars, and you can take the delivery in these four currency. And the tick size is, let's say, around outright is $0.50 and carries is $0.01 if you are carrying the contract. So last trading day up until the close of the first ring of the day before the prompt day. And then settlement type physical. So that means finally settlement will be physical, so you have to make the full payment and collect, and there is no net settlement. So this thing was for LME future contract specification. So if you want to read more, you can just scroll through the site, and then we have physical contract specifications. Now, in what shape they give? They give you in cathode shape. When you are buying, let's say, taking delivery of the copper contract. Then in options, we have again the lot size 25, and contract months are monthly and out to 63 months. So you have an option contract to buy till 63 months on LME. Great. And the strike price, you can understand all these options, strike price and all. So just have a look at the contract specification of copper future on LME. Now also let's have a look at MCX contract specification for copper. The symbol is copper, then description is copper MMM. So description is in copper, let's say January and 2050. So this is complete description. Then trading period is Monday through Friday, so that means 5 days you can trade. The trading session is for 10 AM to 11:30 PM. Trading unit is 1 metric ton. That means the lot size is 1 metric ton. And the quotation is base value is 1 kg. And here the quotation is price quotation US dollar per ton. So here the quotation is based on ton, and here the quotation is on per kg. The maximum order size is 70 metric tons. Okay, and price is quoted XB1D. Okay, basically this is the warehousing for copper of MCX exchange. and the minimum tick size is 5 paise per kg. See, basically what is tick size? Let me explain you. Tick size is the minimum price change into the minimum price change of that commodity or in a stock. So let's say you can buy for, let's say one stock is trading at 100, you can buy it for 100, and let's say if the tick size is 5 paise then, or 5 cents, so you can buy at 105 cents, 110 cents, 115 cents, but you cannot buy at 101 cent or 102 cents. You cannot quote like that. So minimum price change will be in that case minimum 5 cents. So that is your tick size. So what is the tick size here? Let me see. The tick size here is 50 cents. Okay, on ring. Okay. So they have three kinds of trading done: ring, LME select, and indoor office. So in these three kind of trading, we have different kind of tick sizes. Then the base price limit will be 4%. What will be the daily price limit? Now I tell you one thing, every exchange have this facility, daily price limit. What is this thing? This actually saves trader from a lot of mishappenings. The exchange says, the MCX says, if the price will fall below 4%, the relaxation will be allowed up to 6% without any cooling off period. In case the daily price limit of 6% is also breached, then the cooling off period of 15 minutes will be provided. So that means if due to any bad news or panic selling, the price let's say crashes, I'll say above 6%. So what exchange does is they hold the trading for 15 minutes so that the traders get time to think, and quite possible that the price will not react as sharply as actually is maybe reacting due to any news or any rumor or any panic selling. So it just simply gives traders time to think. Now one more thing is also, this also gives the time to the broker to collect the maintenance margin from those guys whose accounts are short of margin. So both the way, both the traders, also the brokers, both gets benefited. Broker gets the time to make call to their clients and ask them, boss, you're going to deposit the remaining margin or shall we square off your position? Okay, and the traders get time to think. So normally it is a good sign. Now initial margin also is given here, the 5% or based on span, whichever is higher. So span is a standard portfolio, something is there, I'm just forgetting the name. Okay, so standard portfolio analysis average, I don't know, we just check out. So basically the 5, this is the margin, whichever is higher has to be paid. Okay, and then we have maximum allowable open position. Delivery unit you have to pay is 9 metric ton. Delivery margin is 25% you have to pay, and remaining you have to pay at the final settlement. And delivery center within 20 kilometer outside Mumbai and octroi limit. Okay, so there are other terms and conditions in the contract. So if you want to have a detailed contract, so you need to find out if we have a very detailed contract on LME. We have mini futures also if you don't want to buy 25 metric tons on LME, and you can trade in 3 ways on LME. We have inter-office telephone, LME select, and then we have ring. The broker will tell you what features you can avail. Contract code CA. This is the code for the LME copper future, the symbol. So you just have to explore the website to learn more. We have historical data. We have LME live. sign up for a week free trial. I'm so sorry. I don't want to go over the sign up process right now. Don't do my apply credit cards and all. Okay, London Metal Exchange. Fine. So this is how the contractor specifications looks. And we have understood what is basically the initial margin. Now let's understand what is maintenance margin. Now, maintenance margin is the balance a trader must maintain in his or her account as the balance changes due to price fluctuations. It is some fraction, perhaps 70% of initial margin for a position. If the balance in the trader's account drops below this margin, you get a margin call, and the trader is required to deposit enough funds or security to bring the account back to the initial margin requirement, as it helps the broker when the trader is not able to pay the losses. Okay, so what exactly it is? Let's suppose we have seen that the copper contract required around for 5% margin, so that was around 18,000. Okay, rupee. So it says that there has to be 70% as your maintenance margin, or let's say consider for the sake of easy calculation, make it 80% is the initial margin. So that means if the balance in your account drops below 4%, okay, in that situation you get a call from your broker. So that means, let's say if it goes to, let's say 16,000, your balance remaining in your account is 16,000, you get a margin call. So which means that if the price falls just 1% down, okay, so 80% of this 5% is 4%. So this is the maintenance margin level. So that means 4% of your total value of the contract. Total value of the contract. So here 4% is total value of the contract, or we can simply say the 80% of the initial margin is 4%. So that means we can say is around 80% of the 18,000. Okay, if this much is there in your account, okay, so 80% is, I'm so sorry, 36, it goes to 14,000. Let's suppose 14,000 goes below 14,000, round figure I'm giving, and you get a margin call. So up to 80%, okay, so that means 18,000 minus 3,600. Okay, you don't get the margin call. That means 14,400, you don't get the margin call till this level. But if your balance in your account drops below 14,400, you get a margin call, because this is 4% which you have to maintain in your account, which is 80% of the 5%. Okay, if below this you get a margin call. So how your balance goes below this? Let's say the price drops 2%. So in that situation, 2% of 350,000 is almost how much? Let's say not 2% even, 1% fall. I'm sorry, 1% fall. So 1% fall is almost 3,500. So 5% to 4% means 1% loss, and 1% loss means almost 3,500 loss. So if 3,500 loss is reduced from this thing, you get a margin call kind of thing. So what happens in margin call is your broker calls you or sends you an SMS and asks you to deposit the short margin, which is, let's say 3,500 or maybe 3,400, whatever it is. I'll tell you how to calculate the exact margin. So let's say that is the amount you have to deposit, and if you do not deposit, they square off your position and give you back that 14,000 rupees in your account. And if you deposit, then your contract is carried forward. Okay, so you remain in the trade. Now the variation margin is the difference which will bring your account back to the initial margin level. Okay, so we have some doubt here. Please explain maintain margin again. Okay, I'll tell you. See, what happens is 5% is the initial margin you have to pay, which was 18,000 of, let's say, 3,50,000. Let's suppose. Fine. And it says that 80% is your the maintenance margin level. 80% of what? 80% of this 5%. Okay. So that means around 4% you have to maintain in your account. So 4% of what? Of 3,50,000. Initial margin requirement was 5% of 3,50,000. That means 18,000. And here it says that 80% of the initial margin position you have to maintain. Okay, that means if the price falls below that level, your position may be squared off. So it is telling you that 4% you have to maintain. Okay, so 4% is around 14,000. Okay, so if you have deposited 18,000 into your account to buy the contract, and let's say on next trading day the price falls, let's say 1% down. Okay, in that situation you will have a loss of 3,500. So if you reduce 3,500, your account balance is 14,500, but you will not get a margin call. Let's say 500 loss is more. Okay, so price falls a little more. Let's say a 0.25% fall is a gain, or a 0.5% fall is a gain. So let's say you lose, let's say 1,000 more. In that situation, if your balance in your account goes below 14,000, in that situation you were not able to maintain the maintenance margin. So in that situation you are given a margin call by the broker, and it reminds you that please put some money in your account and bring your account to the initial margin level, not the maintenance margin level. Again, top up it to the 18,000 level. Okay, so that is the amount you have to deposit in your account. So if you failed to deposit the amount and bring it back to the initial margin level, in case if you fail, then they will square off your position, they will close your position, and they will refund you your 14,000 or 13,500, whatever is there balance in your account. That will be credited back into your trading account or your bank account. Okay, so that is your maintenance margin level. Let's suppose there's a price fall of 0.5%, and you lose around, let's say, 1,500, 1,700, 500 rupees, or let's say there's a fall of 3,500, and you lose, let's say there is a fall of 1% and you lose 3,500. So what will happen in that situation? Your trading account, your initial margin will be adjusted with this 3,500. Now you are left with 4,500. So only 500 is left in your amount extra. Like, extra. If there is a little bit fluctuation in the price anymore, your account will hit the maintenance margin level. In that situation, the broker will call you. Or else, if you see the balance in your account is 14,500, and before it hits the maintenance margin level, you put 1,000 rupees or let's say 2,000 rupees extra in your account, then that will raise your account. In that situation, your maintenance margin is not hit. Let's say not maintenance margin level is not hit. Your position will not be squared off. Okay. So let's say, shall we put more funds? If you are losing money, shall we put more funds to bring the maintenance to the initial margin level, the balance of your account to the initial margin level? Or shall we exit? if we are having losses. I'll tell you one thing, that's a strategic decision that few people would like to come out because they think it's their automatic stop loss. Few people want to remain in the trade and they put more money to maintain the balance. That's a strategic decision. We're going to discuss all those things. When should we do it? However, at this stage, I'll tell you this only the concept that what is maintenance margin. Okay, this is the balance has to be there in your trading account. If it falls below that, you get a margin call. Margin call means your broker dials your number, the phone number you have provided, and asks you to put the money. If you do not put the money, you say, I don't have money, they square your position, give you back your money. Variation margin is the difference between your balance in your account and initial margin level. So let's say you got a call at 3,500 that please deposit money. So from 3,500 you have to again bring it back to the 18,000 level. So in that situation, how much you require? Let's say 4,500. So that is the variation margin, which will bring the account again at the top up level full. Just understand in a simple way. But there is a calculation behind that. Little bit we are missing on. I'll fulfill that when we'll understand the calculation of marking to market, M to M, marking to market. Now, these concepts are applied in every market. Either it's US market, you are trading COMEX, or you are trading in LME area. The concepts are all same, just the contract sizes are different. So what is leverage or leverage ratio? So let's say you pay $100 initial margin to buy $500 gold future contract. So what happens is you are taking a leverage of just 5 times. So that means you are depositing around 20% of 500. So if let's say exchange says that boss, you simply have to deposit $5, so that means you are taking almost 100 times leverage. Okay. So what happens is if there will be 1% change in the price, you will lose entire money. So 500's 1% is 5, and if it's 1%, if it goes down, let's say 4.99, you'll lose your entire 5 rupees capital. So before you invest, before you take high leverage, okay, you should not. You should be very careful about the volatility in the price. And my advice would be for a novice, let's say if you're not an expert or you're not an expert trader, for a novice, you should not go beyond, let's say, 5 times leverage. That means you should always maintain 20% of the total traded value in your account. This will give you less profit, but this will give you a lot more chance to survive because you can hedge, you can average, and also you can apply a few more strategies. Also it will save you from quick volatilities. Normally I have seen in forex, also in commodities also, your stop loss is hit and again the price takes the direction, reverses. So your analysis was correct, you thought the price will go up, but for fraction of seconds it goes down, your stop loss is triggered, and then the price goes up. So in those kind of situation, a little extra margin saves you. Okay, but stop loss is something different. We're gonna understand when should we, how we can maximize our returns by using higher leverages also. But for a novice, keep in mind 5 times is good enough. So that means 20% you should keep in your account. It depends on the exchange to exchange, but Indian exchanges are very volatile, so that's why I'm telling you. Another thing is, what is a good leverage ratio? I tell you, I have read about CDS, that is credit default swap. This time the leverage of normal banks went almost 33 times. That means 3% change in the price, if the property price falls 3%, the entire value or entire deposit with the CDS will be gone. So if price falls just 3%, property price. And you understand one thing dear, that the property prices are highly volatile. It depends on various factors, location, geography, your demography, interest, fashion, many things. And in the same locality, it's quite possible that 100 years above you get different rate and 100 years before you get different rates. So what happens is the pricing in property is a little complicated. Okay, there's huge differences. And the CDS, which were holding underlying asset, basically all the real estate's mortgage loans, okay, and they were trading on high leverage, almost 33 times. So that was one of the reason of recession in the United States, and all the financial system collapsed just because of the derivatives. So some wise person said the derivatives does not reduce your risk, in fact it increases your risk. We're going to discuss someday another on CDS and all, because for now we have to understand what is leverage. So leverage is amount to credit, the times of credit you actually gave. Now how do you terminate a future contract? There are 4 ways. Close out at the expiration. Okay, so close out means if a trader holds a long position, they go into the short the same contract and they close the position. So that means you have bought a copper contract. So let's say you decide to buy copper at 350 and on the expiry you sell it at 360. So you make 10 rupees profit and position is closed. The same contract you have to do it. Okay, if you let's say buy another month or sell another month contract on the expiry by mistake, you bought January contract and you sold February contract, and your position is not closed, you have 2 open positions. So आपके पास 2 open position होंगे. So you have 2 open positions. Delivery. This requires, okay, what is delivery? This requires the long holder to accept delivery of die underlying asset and pay the short positions the settlement price for the previous day. So that means another closing method is that if you want to buy copper, if you have bought copper and you want to take delivery, pay in full, collect the entire quantity, okay, let's say in case 1 metric ton, and take home. So that is another way of settlement. So we call it a gross settlement. Then we have equivalent cash settlement. So what does it mean by equivalent cash settlement? So when the contract expires, the margin account is marking to market and the gain is posted into your account. So what happens is, let's say you have not closed your position. Let's suppose you have not closed your position. You have bought the contract. Now your contract is in profit. If you sell it, you're close. If you do not sell it on 31st of the contract month, the last date of expiry, once the exchange closes, the prices is taken for last 5 minutes average and your contract is being settled based on that price. And if you are into profit, the exchange will give you the cash settlement. The exchange will give you the cash and your account will be settled. Okay, so even if you don't close, exchange is closed and profit will be created in your account. Then exchange for physical. So what is the exchange for physical? In this situation, normally the short sellers of the contract will deliver the goods to the exchange. Okay, so buyers takes the delivery and sellers gives the delivery. Okay, so when we are trading, very simple: buy a contract, sell a contract, make profit, position closed. If you want to go into delivery, buy a contract, mark for the delivery, pay in full, collect the delivery, go home, take it and go home. So both the options are there. Then what is open interest and trading volume? Okay, so open interest and trading volume is normally it will take another, let's say, half an hour, maybe 1 hour to explain you. And then we have one more concept, that is marking to market concept. Would you like me to carry on with this thing furthermore, or you want to keep it for the next week? Shall I carry on or shall I keep it for the next week? It's up to your stamina. Or too many concepts we have actually discussed today and you don't want to take any more over your head. Moni, tell me about yourself. You want to carry or you want to keep it for the next week? Moni Gupta, next week, Paul. Break. Okay, see, if we take a break, we have to take at least 5-10 minutes and then we'll start. Let's do one thing, Paul. Let's keep it for the next week because too many concepts are there. You are a little experienced. The girl is not that much. So take both the students in the class and one person is also absent today. So in that situation, that if you go far ahead today, it will be again more difficult for him too. Okay. So what we do is we keep it for the next week and I'll do it in the next week. Okay. What you have to do for the current week is just explore the website of the exchange, understand the concepts, the videos will be uploaded, I mean maybe tomorrow, okay, and I'll send you the link. And the assignment you have to do is a little bit, it's not an assignment, it's a little bit request that please just visit the website of these exchanges and try to see a few contract specifications and just understand what is the margin required for that contract to trade. Okay, just understand these few things. Okay, and also check from your broker. If you have a broker in your area, let's say we have SMC, Sharekhan, Angel Broking, ICICI Direct, HDFC Bank, Citibank. We have RBS, Royal Bank of Scotland, many offering trading online in MCX. So Moni can check with any of these guys about a trading account. Also, Paul, you can also check about for a trading account of commodity with any of these brokers. Okay. So take care for today, and we'll catch you in upcoming week, and we'll discuss from here. Discuss further. It's good night and happy weekends. Not now, but it's 2 days far. See you next day. So thanks. Take care.